bank run by telling the companies to pull their money out, creating more chaos, more panic.
SVB failed because the bank's management did not effectively manage its interest rate and liquidity risk. And the bank then suffered a devastating and unexpected run by its uninsured depositors in a period of less than 24 hours. Immediately following SVB's failure, Chair Powell and I agreed that I should oversee a review of the circumstances leading up to SVB's failure. In this review, we are looking at SVB's growth and management, our supervisory engagement with the bank, and regulatory requirements that applied to the bank. The picture that has emerged thus far shows SVB had inadequate risk management and internal controls that struggled to keep pace with the growth of the bank. Supervisors began delivering supervisory warnings near the end of 2021. Our review will consider whether these supervisory warnings were sufficient and whether supervisors had sufficient tools to escalate them. We are also focusing on whether the Federal Reserve's supervision was appropriate for the rapid growth and vulnerabilities of the bank. While the Federal Reserve's framework focuses on size threshold, size is not always a good proxy for risk, particularly when a bank has a non-traditional business model. Turning to regulation, we are evaluating whether application of more stringent standards would have prompted the bank to better manage the risks that led to its failure. Staff are also assessing whether SVB would have had higher levels of capital and liquidity under those standards, and whether such higher levels of capital and liquidity could have forestalled the bank's failure or provided further resilience to the bank. We need to move forward with our work to improve the resilience of the banking system, including the Basel III Endgame reforms, a long-term debt requirement for large banks, and enhancements to stress testing with multiple scenarios so that it captures a wider range of risk and uncovers channels for contagion like those we saw in the recent series of events. We must also explore changes to our liquidity rules and other reforms to improve the resilience of the financial system. In addition, recent events have shown that we must evolve our understanding of banking in light of changing technology and emerging risk. Part of the Federal Reserve's core mission is to promote the safety and soundness of the banks we supervise, as well as the stability of the financial system, to help ensure that the system supports a healthy economy for U.S. households, businesses, and communities. Deeply interrogating SVB's failure and probing its broader implications is critical to our responsibility for upholding that mission.
The FDIC will undertake a comprehensive review of the deposit insurance system and will release a report by May 1 that will include policy options for consideration relating to deposit insurance coverage levels, excess deposit insurance, and the implications for risk-based pricing and deposit insurance fund adequacy. In addition, the FDIC's Chief Risk Officer will undertake a review of the FDIC supervision of Signature Bank and will also release a report by May 1. The FDIC will issue in May a proposed rulemaking for the special assessment for public comment. The two bank failures demonstrate the implications that banks with assets over $100 billion can have for financial stability. The prudential regulation of these institutions merits serious attention, particularly for capital, liquidity, and interest rate risk. Resolution plan requirements for these institutions also merit review, including a long-term debt requirement to facilitate orderly resolution. Recent efforts to stabilize the banking system and stem potential contagion from the failures of FSB and Signature have ensured that depositors will continue to have access to their savings, that small businesses and other employers can continue to make payrolls, and that other banks, small, medium, and large, can continue to extend credit to borrowers and serve as a source of support. The FDIC continues to monitor developments and is prepared to use all of its authorities as needed. The FDIC is committed to working cooperatively with our counterparts at the other federal regulators, as well as with policymakers in the Congress, to better understand what brought these institutions to failure and what measures can be taken to prevent similar failures in the future.
After consulting with the President, 2 actions that would enable the FDIC